Okay, good afternoon, everybody. Thank you for joining this InvestEngine webinar in partnership with Xtrackers, which is all about where next after US equities. I'm Andy Prosser. I'm the head of investments at InvestEngine, and I'm joined today by Lukas Ahnert, who's a senior passive product specialist at Xtrackers, and Toby Dudley-Smith, who's the head of Xtrackers sales in the UK. Now, in terms of the plan for the webinar, it's the usual story. It's going to be a bit of a Q&A. So I've got a few questions which I think people will likely want to know the answers to. So we'll start off with some of those. But I'm also going to be picking questions from the Q&A as well for the end. So if you do want to ask questions as we're going through the webinar, you can click on the Q&A button at the bottom of your screen. The questions won't be broadcast to the whole webinar chat. They're just going to come straight to us. So feel free to ask away and we'll answer as many as we can at the end. Now, it's my job to make sure that everything runs on time. So I need to make sure that I leave enough time at the end, probably kind of 5 minutes, something like that, for a quick demo of how to buy some of the ETFs on the InvestEngine platform. So I'm hoping that once we've wrapped everything up, we've done the presentation, we've done the demo, and we've done the Q&A, we'll be wrapping everything up at about 5:45-ish. But before we get going, I just need to mention the usual disclaimer that your capital is at risk whenever you invest. This webinar is for UK clients only, and that none of this is financial advice. So with that, I'm going to hand over to Lukas and Toby in a second. But just before we get stuck into the questions, Toby, maybe you can kick us off by giving us a quick intro into who you are, who Xtrackers are, for those who might not be familiar.
Yeah, thanks, Andy, and good evening, everyone. My name's Toby Dudley-Smith. I'm head of coverage for UK and Ireland, and joining me is Lukas Ahnert, who's senior product specialist on the product structuring and development team. Xtrackers, how you think of us, we're the ETF arm of DWS. We manage just north of 330 billion euro of assets across ETFs, ETCs, and mandate solutions, which makes us one of the largest ETF providers in Europe, with about an index replication track record over 25 years. Pretty broad spread in terms when it comes to solutions. We offer solutions across all asset classes, fixed income, equity, commodities, even in the crypto space at the moment. And we track over 300 benchmarks. So we like to think whichever way you're trying to express a view, we do have a solution that hopefully helps you implement that.
Okay. Oh, here we go. You got a slide to talk through. Have you talked through all the points there?
Yep.
Yep, happy with that. Okay, let's get stuck into some of the questions then. Good stuff. So we did a webinar together earlier this year in January, where we discussed why investors might want to be reviewing their Magnificent Seven exposure, right? So what's happened in markets since then? How are you seeing investors positioning themselves in the kind of current phase of market volatility?
Yeah, I mean, it's been a remarkable turnaround in markets since the start of the year. And most of that has been really, I guess, an unwind of the Trump trade. Now, if you think back to November when Trump won the election, even if many people weren't politically aligned with his views, the feeling was that he was probably the better candidate for the economy than Harris. And investors were very much focused on, okay, Trump 2.0, pro-business policies, tax cuts, deregulation. And straight after the election, you saw the dollar rallying, big dollar rally on stronger views of expected economic growth. Equity markets rallying. I think the S&P was up about 2.5% on the day. And Trump had very much spoken that he was the best president for the US markets in his first term. Domestic focus, US first. And the view, I guess, was broad. US equities would rally. We might see a small cap rally as well, beneficiary from the tax cuts. And really, I guess the consensus was we were going to see ongoing US market strength. And even on big tech continuing to flourish, certainly with Elon Musk inserting himself into the White House as his right-hand man, Zuckerberg at his inauguration. The feeling was that the rally in big tech, although stretched and valuations very high, it was probably look set to continue. And even like risk assets like crypto, there was a very sort of strong view that Trump would be bullish for crypto, right? We saw Bitcoin jump almost 9% after the election, and he'd branded himself as the sort of pro-Bitcoin candidate, vowing to launch a strategic national crypto stockpile. But in reality, and what we've seen in the last couple of months, is a complete reversal of this, and with many of these assumptions being shattered. US equities, the one market that no one could afford to be underweight in recent years, given how strong the performance has been, has begun to significantly underperform the international equity markets. To put this in like context, you had the MSCI USA, I think, was up 25% last year. This year it's down 3%. And on a relative basis versus World ex USA, so looking at developed market equities, cutting out the US, it's underperforming by about 12%. And on the dollar, we're down about 4% year to date, facing its worst year since 2008. I think there's sort of growing concerns that sweeping tariffs are going to put the brakes on US growth. And if we look at big tech, and we look specifically like the Mag 7, down more than 12% since mid-Feb, and Bitcoin's down 7%. So all those expected Trump trades have really been clobbered this year. And coming into this year where I guess investors were rightly concerned about concentration risk, sky-high valuations, you've given and coupled this, I guess, with Trump's unpredictable economic and foreign policies, have certainly created a lot of jitters in the market. And yes, big tech has also come under pressure because you've seen some mixed earning results. And a month or so back, you had the emergence of China's AI DeepSeek, which has certainly, I guess, raised questions about America's AI dominance. And Andy, you said in your opening question, well, what impact has this had on positioning? Well, perhaps probably unsurprisingly, this weakness has had a huge impact on sentiment and equity allocation. We know going to the start of this year, positioning in US equities has been exceptionally crowded. And actually, sorry, if you go on to slide 3. So this is effectively just talking about all those particular areas that have reversed, right? So Trump being good for US equities, no, that's not what we've seen the last few months. Big tech, we've seen a big correction in the Mag 7 and dollar weakness since February as well. And then the bottom quadrant is the underperformance of Bitcoin. That's been pretty dramatic.
And that shaded area there, that's since the election, is that right?
Correct, yeah. So in the last 4 months. Now,
that one.
Yeah, it's pretty significant. So, and if you go to the next slide, I think this is an interesting one. So, if you basically look at the asset weighted look of the top 300 largest physical equity UCITS ETFs, so these are obviously ETFs available to European investors, and you break out the country of risk, you can see exactly how big an exposure investors on average have to the US, and it's almost close to 60%. So yeah, yes, US investors are heavily exposed to the US. And so then I guess it's not surprisingly that we've seen a huge amount of investors begin to rotate out of the US and into other international markets. And if we look at the right-hand side chart, this effectively shows rolling 30-day net new assets. So the orange line shows the flows or inflows, outflows into US equity funds. And what's been pretty striking since really, I guess, end of December is that there's a clear downward trend. So obviously the pace of inflows into the US has slowed, but we're also beginning to see the emergence of negative US flows as well. Whereas in stark contrast, we've seen inflows into European equities significantly beginning to pick up and even outpacing flows into the US for the first time in many years, alongside a notable pickup interest in emerging markets and even Asia as well.
Yeah, that's an amazing chart on the right here. There, it's interesting to see how the US and the world kind of mirrored each other up until the beginning of 2025, when the US has just fallen off a cliff. It looks like, even as you say, just going to negative flows there very, very recently, but global flows have still continued pretty strongly.
Yeah, and we have seen global equity flows taking a bit of a hit. And worth pointing out that actually, if you think about something like MSCI World, probably 70% of the exposure is to the US. So there is a bit of a misnomer here that clients are sort of diversifying, they feel, out of US into global equities, but actually they still have a very large US equity allocation within that MSCI World Index. So that's something to definitely be mindful of.
Yeah, and speaking of which, Lukas, maybe a question for you. We've heard so much about US exceptionalism over the last few years, and now investors are kind of questioning a little bit whether it might be coming to an end. So, what's really the role of US allocations in this potentially new environment, and which areas of the US market specifically are investors looking at right now, do you think?
Yeah, sure. Let me comment on that. I think the next couple of slides go into that. So maybe if we move down one slide, then we can discuss basically a little bit that US market in more detail, right? Because I think what is without question, of course, is just from a positioning perspective. I mean, it's hard to build a portfolio without the US, right? And also, I think that shouldn't be really the takeaway from the comments that Toby just made, that basically it is about divesting from the US market, but it is probably about finding within the US also different allocation building blocks that might be a little more resilient in this environment that we're entering, and that are definitely not kind of like priced to the same extent that maybe some of those top names in these indices are. But the fundamental role of US in equities allocations, I think, is super important, right? I mean, if we just look back the last couple of years, where have all the big innovations over the decades have come from? A lot of them originated in the US. The US is 30% of global GDP. It drives significantly global growth as well. A lot of that growth that we've seen there the last couple of years was debt fueled, right? I think that's also one area where Europe is now catching up by basically just borrowing more, spending more, and thereby driving the economy, driving the stock market higher. That was maybe then one of those areas in the last couple of years where also the US probably moved a little too far, versus kind of like historic valuations versus the other regions. And that's where we see then a bit of a reversal. Now, if we look at the US market specifically, the picture that Toby painted is really valid throughout the capitalization spectrum, right? There are very different indices for the US market. Some look at the large caps, some look at the smaller caps. The Russell 2000, for example, is one of these classic smaller cap indices. But that chart here on the left-hand side shows that negative performance that we actually see pretty much across the entirety of that market on a year-to-date basis. And it's actually opposing a bit, maybe there's this initial view that investors had. I think when we were speaking earlier in the year, I think one of those big mantras that investors were still following was this idea that, well, the small caps might come back at some point, and that basically Trump policies could help the small caps. So far, we see relatively little of that. Now, one area where we do still see like a little bit of a performance pickup, at least relative to the S&P 500, so basically just catching up a little more after long periods of underperformance, that's the equal weight. And you can see that nicely in the right-hand side chart here in terms of relative performance. You basically have in the gray colors a lot of these relatively concentrated top indices, the NASDAQ 100, for example, that corrected a bit also on a relative basis versus the S&P 500. It came closer to those stocks again. But at the same time, also the gap for the Russell 2000, for example, so the small cap segment, didn't really close. And I think I mean, we discussed already in the last session about how the S&P 500 equal weighted index works, the construction, the ideas behind it. The quick summary again is that this is basically an investment to the average stock, right? You're equal weighting the S&P 500, 20 basis points or 0.2% allocation to each stock, and you reset that relatively frequently every quarter, and hence you're very much diversified across the US economy. And that is then a good gauge of like, how does the average stock actually perform? So the interesting question really is, why is that average stock in the US actually showing a little more of a positive sign than the rest of the economy, and especially versus the small caps? And the next slide give at least a little bit of an explanation here, I hope. It is a comparison between those 500 stocks equal weighted, so the top 500 stocks, and the Russell 2000, so those smaller names that are not really in your traditional indices. In your MSCI World, for example, you wouldn't access those names, but they're further down in the capitalization spectrum, they're smaller names. Now, the big point about those Russell 2000 companies is that actually a lot of them are relatively poor in quality. So they are not necessarily the most profitable companies. 50% of those companies aren't profitable at the moment. And hence, those are typically also names that are a little more susceptible to the performance of the US economy. And that's exactly what the market is playing the last couple of weeks, where basically also just US sentiment becomes a bit weaker. And hence, those names also don't really catch up that much. Whereas on the equal weighted basis, that index is typically characterized by a little more quality, simply because, and it's basically index governance, because a stock to be eligible for the S&P 500 actually needs to be profitable. And here we're basically just taking a quality subset of the overall US equity market, the 500 largest, then you equal weigh, and then you are entering kind of like, say, some tilts in the portfolio that don't lean into your value and the cheaper stocks in the same extent that the equal weight would do. So it's, from that perspective, still a preferred diversification trade at the moment for many, and probably still one of those blocks to look at if you are still staying true to the US market, maybe even in the same extent that investors were allocated before. So your 60, 70% allocation, but basically replacing market cap weighted exposure with equal weighted exposure just to diversify further.
Yeah, that's really interesting to see how much kind of difference and dispersion there is even just within the US market, right? And that there's so many options, even if you're just investing in the US, for you to diversify. Toby, maybe one for you. Going beyond the US a little bit, as you mentioned before, Europe, that's the big comeback story so far this year. So what are you seeing as driving the rally? Can you just put that whole story into perspective a little bit?
Yeah, sure. I think Europe has long held a reputation as a value trap, and it's been cheap for a very long time, right? Trading at significant discounts to the US. I think that the view was, there's huge structural headwinds, weak productivity, cyclical headwinds, market fragmentation, overly regulated, etc. And the general consensus was, this is stifling growth, certainly compared to the US, where, very much a high-octane, innovative growth market. But I think certainly in the last 12 months, there's been a clear change in sentiment, and you might call a great Europe reawakening. If we look at the next slide. Yeah, so here on the left, we can see, we can look at the relative performance of certain European equity indices versus the US. And you can see really since probably November last year, sort of end of November, a stark turnaround in performance. To put some numbers behind it, the DAX has outperformed the S&P 500 by 14%. Oh, sorry, it's up 14% this year versus the S&P, which is down 7%. In fact, I think it's outperformed the most at any stage of a year since 1960 in terms of the strength that we've seen this year. The Stocks Europe 600, so slightly broader index, is up 8%. And even the FTSE 100, which is the UK has been, it seems like the sick man of Europe for some time, is even up 6%. So there's a big stark contrast in the performance of European and UK equities versus the US. And we started the year with the biggest valuation discount since 2003. And if we look at the graph on the right, even after these significant market moves, which I think have probably taken a lot of the market by surprise, I think most houses were probably fairly constructive on Europe, but probably didn't anticipate to see the strength in the rally that we've seen just in the first few months of the year. But even with the bigger market moves, Europe, Germany, etc., still look cheap relative to their long run average, right? So compared to the long run average, the value discount relative to the US still has further to go. So it's not as if I think we're even after this rally we're back to levels where you could say actually now there's question marks whether Europe still offers value. And maybe if we could move on to the next slide, you can start seeing some other details around the sort of the magnitude of the move. So the bar chart on the left effectively shows the year-to-date and returns, which are in orange, and the 12-month returns in grey. And what's very evident is, along with China, Europe has been the standout performer across all of global equity markets. You can see, I mean, I mentioned China. It's an interesting one, actually, because China, a bit like Europe, has been unloved for some time. But there is now a feeling that perhaps we should see some decent Q4 earnings coming through. And then obviously with the AI DeepSeek headline busting news that came out last month, suddenly the AI story is very much in the ascendancy over there, and can this disrupt some of the US tech names? And the other interesting thing is, where everyone's focused on tariffs, only probably 3% of China's revenues come from the US. So and if you look at all of the US's trading partners, so it's 10 largest EM trading partners, it's actually the lowest among those. So yeah, the US has been the worst performer, down 7% alongside India. And the MSCI World, as we discussed briefly before, has also struggled performance-wise, and that's undoubtedly been weighed down by the large US weighting within it, which I already stated is around 70%. Now, interestingly, if you look at the whole of Europe and the chart on the right-hand side, effectively this shows the net total returns of each European country and the UK over the last year. I think it says over the last quarter up above, but actually it's over the last year. And I think what this indicates and reflects quite nicely is the full breadth of the rally. Pretty much the whole of Europe has had high double-digit returns in the last 12 months or so. Probably on average between 15 and 20%. So even where you would expect to maybe see kind of a difference in performance of maybe Northern versus Southern Europe, actually there's been sort of outstanding performance across the board. Now, Andy, you asked in terms of what's driving the rally. Well, I would say a few things, really. One, most recently, we've seen a big stimulus package announced from the new government in Germany, who have announced a 500 billion infrastructure fund. So we think the beneficiaries of that are going to be construction, defense, energy, and digital infrastructure. There's also seems to be a bit of a decoupling if you look at central bank policy between the US and Europe, and certainly monetary easing probably seems it's more likely to continue in Europe than it is in the US, primarily because inflation's moderating here, where it seems to be a little bit stickier in the US. So certainly there seems to be a different path. And then after a long last, the corporate picture is definitely looking healthier. We're beginning to see some earnings upgrades come through. And also the big topic is around the Russia-Ukraine war. And there may be a potential ceasefire in the offering, which obviously is going to you would expect to be very well received by the market. And I think also as well that there's now a growing perception amongst investors that perhaps for the first time in a long time that maybe Europe is a safer bet than the US at the moment. And I think that's probably a reflection of the political landscape, that maybe Europe offers more protection against economic shocks than US equities. And if you couple all that with the compelling valuation argument that we touched on the previous slide, I think you can definitely understand why investors have become more bullish and more constructive on Europe. Maybe Lukas, I'll pass it on to you, perhaps to maybe dive a little bit more deeply into the country view and explain also what we're seeing at the sector level.
Sure, yeah, I can do that. So if we go to the next slide, what we've brought along is, say, the more granular picture of Europe, right? So basically a look through across the different countries, the different sectors, the different factor indices, and how they have performed. Every single dot here on that chart is an index, right? So for example, the country indices, they're in orange. And we have two axes. We have one axis on the vertical side that measures the total return, right? That's the total return over the last 12 months in euro. And on the horizontal axis, I've put the valuations. So these are valuations of a certain market or country, right? So pick Germany, for example. We value Germany versus its own history. So we took 20 years of history. How is it valued versus itself? So a good indicator of if an exposure has gotten more expensive versus its own kind of like average and history. And then it's kind of like just standardized to all put it into one chart and scale it. We then know basically where's the most momentum in the market and where are maybe like still some segments of the market that are relatively cheap. The big development that basically Toby mentioned already, right, is that this kind of like resurgence of Europe, for now at least, pretty much lifted all of the boats, right? You pretty much have all of those dots above zero, which shows the strong performance across the different categories. Now, that performance also for some indices already meant that they got relatively more expensive. So not only do these dots, if there's performance, move upwards, but they also start moving towards the right because they, from a valuation perspective, they get more expensive over time. And Germany is a good example here. The DAX, as Toby mentioned, performed very, very strongly, strongest start to the year. But actually, where if you put that into perspective to where the perception of that valuation of the German equity market was before, it is already leaning towards the more expensive extreme. Now, I've also put the US, by the way, in gray, just for reference. So that's the broader US market. So very few dots would be approaching that territory of valuations. But you do have a few where you'd say, well, Europe or also industrial, so typical sector that benefits a lot from this defense trade that we've seen. They've moved quite far. And it does make sense also for investors to consider some of those dots more on the left-hand side, where arguably catch-up potential, at least on paper, is still higher. Right? But so far, I think it's also part of the story that most investors, they have chosen the big allocation building blocks in Europe, right? So the broad indices, your indices such as MSCI Europe or Stock 600 that kind of like unite all of those names here that we have in the more granular fashion on the slide to just have the broad exposure. And then figuring out where exactly maybe investors want to allocate more of their money, be it in a specific sector or in a specific country, that's probably then an exercise for later on as well.
Yeah, that leads me on very nicely to my final question for you, Lukas. So speaking of sectors, I guess, what we've seen this year is really just a good reminder that diversification is really important in portfolios. Are sectors a useful starting point for investors who want to diversify their portfolios a little bit more? And what other routes do they have to kind of improve their diversification?
Yeah, sure. Let's cover that in a bit of detail. If we go one slide down, I did bring along one chart that illustrates this this point quite nicely. Overall, my answer would be sectors are a good starting point, but probably not in isolation, right? You should never like look at just one sector as a means to generate outperformance, simply because the history tells us the volatility of a sector's performance is actually quite significant. A lot can go wrong basically by banking on just one sector. Tilting an existing portfolio more towards a certain sector is something completely different than just basically picking one sector. I think that's quite clear. And the chart here illustrates that. So what we took are the MSCI world sectors, just for illustration, right? So we take the global sectors, slice them up. IT is one of them. You've got communication services, materials, financials, etc. 10 of those sectors. I've also put some other related indices on the same chart. And we look at a 20-year time frame. And that's just a time frame that I picked from 1999 to 2019. So kind of pre-COVID. So this is before your COVID shock. But it does tell a very clear message. We have two axes. We look at the maximum drawdown that was perceived in any of these single sectors. So how much did they lose at any one point? So what's the kind of like maximum loss that we have seen in a sector? And then also how long, that's the horizontal axis, how long did it take to recover from that drawdown? So just to pick out one example, towards the far right, we find information technology. Information technology had a drawdown of 80% as a sector during the dot-com crash. That sector lost 80% of its value, and it took that sector almost 15 years to recover from that, simply because it took some time to build the performance again. Now, for an investor that tries to time the market a bit and steps into a sector when it's sold off, that shows that there is some potential maybe to use sectors to gain some extra performance. But at the highest level, it also means it does make sense to be quite diversified across the portfolio still. It's a good reminder of that mostly, right? I have put the dot for world as well. So MSCI World, you can see that the drawdown is a lot less than what we've seen with sectors, right? There were only two sectors, consumer staples and healthcare, that historically had less of a drawdown, less maximum risk than a broad world portfolio. And also that world portfolio recovered within the scope of about 4 years from that shock. Whereas especially some of the sectors that we see towards that far stretch on the right-hand side are really good reminders that it is a risk of actually destructing a lot of value here as well. If basically you're putting an allocation to a single sector, that sector faces some idiosyncratic risk, dot-com, financial crisis, for example, and they then take a long time to recover. So good starting point for diversification, but ideally not seen in isolation, always with other building blocks in the portfolio. Then it becomes something more robust. I think it's also a good lesson, I mean, overall to think about diversification though. And the next slide just gives the full picture really on how diversification tools work for investors. There is a broad range, right? From traditional equity diversification, that's just what we discussed here on this slide. But on the next slide, we also have some other building blocks that investors can use. Fixed income, for example, historically has always been a good diversifier in the portfolio context. And there are even additional building blocks many investors can now access: gold, other commodities, or even kind of like your listed infrastructure, listed real estate solutions. The spectrum is really, really broad. And the diversification potential that can come from this is quite significant. The chart here just gives you an idea of where do they rank relatively. We've taken a portfolio that's quite similar maybe to a lot of portfolios. It is a US domiciled portfolio here, 50% equity, 50% bond exposure. And then we've just assessed what is the correlation across those different segments. Equities help to diversify, but the very strong correlation, that really decorrelation or extra diversification, let's call it, that comes from fixed income and comes from many of the alternative buckets that are available to investors as well. which means that's also, I mean, when we look at the year, rising risks on all sides, valuation in the US, geopolitical risks, thinking about diversification more broadly and protecting maybe also some of the gains that many investors have seen over the last couple of years, then a broadening of the portfolio beyond equities can also be very sensible. The last slide of the deck just basically gives a good illustration of that again. So again, we're taking the perspective of the drawdowns, right? So what's the maximum kind of drawdown at a specific point in time that investors have experienced? And we're benchmarking two different portfolios. One is a US only portfolio. Oh, sorry, both of them are US only, but very different composition. One is equities, S&P 500, and the other one blends in 50% treasuries as well. And the shapes are quite different, right? So your drawdowns in a pure equity portfolio are typically a lot higher than in a more diversified portfolio. That's what the last kind of like 30, 35 years of history are telling us. And that's, I think, also a good takeaway for investors, because the last 2-3 years aren't necessarily really a good illustration of how longer term diversification really works. A lot of that on the fixed income side, the last couple of years didn't really work in the investors' benefit because also rates did move quite significantly. But if you look at the long term, a diversified portfolio that goes beyond equities has a very solid track record from a risk management perspective.
Thank you very much, Lukas. I'm just conscious of time. We've got about kind of 8 to 10 minutes left, so are coming towards the end of the webinar. I'm going to do a quick platform demo in a second. But in the meantime, please, if you're watching this, do feel free, keep the questions coming. I can see we've got some coming through in the Q&A box already, but do keep them coming. If we don't get a chance to answer them today, the Zoom software automatically records all the questions. So we'll hopefully get back to you after the webinar. But I'm now just going to share my screen, if this works. Here we go. So hopefully that should be sharing now. We've got a dummy account to walk through here. I'm logged into the InvestEngine platform. You can access it through your browser or the app. You can go down to the portfolio. You can either open a new portfolio or choose an existing one. I'm just going to choose this one here. I always use it for demos. I know it works. DIY one, very imaginatively named. I'm going to scroll down here. You can see it's done pretty well and then fallen off a little bit recently with the market sell-off. We've got 2 funds in here, but what I want to do now is add securities. So we go into add securities and we click the Xtrackers banner here. So that loads up all the Xtrackers ETFs. You can see they've got a huge selection of very low cost ETFs on the platform. We've mentioned a few different kind of themes today. We've mentioned equal weight, we've mentioned sectors, we've got Europe, factors. So there's ETFs that capture all of those themes here. I'm going to search for Europe. And you can see here, we've got a whole bunch of European Xtrackers ETFs on the platform. I think Lukas, or maybe was it Toby, mentioned the Stocks 600. So I'm going to select that one as the example one here. So we can see how it's performed. We've got some nice ETF stats here and a nice long description of what the ETF does. I'm going to add it to the portfolio. There we go. We can see in the top right here, it's now been added to the portfolio. We continue. And this is the screen where we change the allocations. I'm going to take out the global allocation and stick in the European market. And we're going to review and continue. And this screen here is a really good look through of the portfolio. So you can see how that change would impact your portfolio. You can see that we're having a big increase in Europe ex UK in the regions as we'd expect, a big increase in UK as we'd expect. If you flick through to the sectors, you can see we're increasing financials, we're reducing industrials, we're reducing technology, kind of what you'd expect if you're taking out a global exposure and putting in Europe. And down to the stock level as well, you can see how it impacts the stocks that you hold in your underlying portfolio. So we're happy with that. We click save and continue. And you should see that the target weights are now all updated. We can scroll down to the portfolio and we can say, yes, here we go. We've got a 0% current allocation and a 50% target allocation. So all that we'd need to do now, I'm not going to do it because this is a demo account, so it wouldn't work. I would go options and I would go rebalance portfolio, and that would then do the rebalance for me and invest in line with my target weights. If you have not invested yet, you just click invest, the nice big button there, and you can do a one-off contribution. If you want to set up a regular investing plan, you just click set up a savings plan, and it goes through all the different options for how frequently you want to invest and how much you want to invest on a regular basis. So it really is as simple as that. Now, I've tried to kind of speed through that bit a little bit so we get more time for the Q&A, because I can see we've got a lot of questions coming through. So I'm going to stop sharing my screen and see what we've got in the Q&A. Right. Okay, I did see one coming through as you were talking. I think it was Lukas. So maybe to give you guys a break, I will take the first question, give my spin on it, and then you guys can chip in if you've got anything to add. Somebody asks in the chat here, if I'm investing with a long-term view, kind of more than 10 years, should I be concerned with the decrease in the value of US equities, or is it something that can be ridden out and will likely recover during my investment horizon? So I guess my answer to that would be, it's very easy during market sell-offs to get worried, but I think all you need to do is stick to the basics. Make sure you're doing the basics really, really well, and you'll be fine. So those things are, make sure you're diversified. Make sure you're diversified by country, by sector, by asset class, all the things that Lukas and Toby have been talking about today. Make sure that your portfolio has that diversification inside it. A really important one is to make sure that you are split. You're split between your equities and your bonds. Make sure that's appropriate for you. If you're not comfortable with the kind of market sell-off that we've been seeing recently, and you're a little bit worried about it, maybe it's a chance to tweak your asset allocation, maybe just increase the bond allocation a little bit, because this is just, we've had a kind of 10, 15% correction. There will be bigger corrections throughout your investing life. So you want to make sure that split's appropriate for you. Don't make any extreme decisions. Don't make an all-in or all-out decision. Make sure you're not overpaying. Keep your costs low, which again, all the Xtrackers ETFs on the platform are nice and low cost. You saw me demonstrate the savings plan button there. Make sure you've got a regular investing schedule set up. Pound cost averaging is a really good way to take advantage of those market sell-offs. And if you tick all those boxes, then I think you're still going to be in a pretty good spot, even if the market does fall. Because over the long term, the stock market's still your best bet for high long-term returns. I always like to think of that quote. I can't remember who said it. It might have been Warren Buffett who said, the stock market is the only place where when everything goes on sale, everybody runs out of the store. So don't run out of the store. Keep investing, stick to your regular investing plan, and focus on the long term. So that would be kind of my answer to that one. Anything to add, Lukas, Toby?
No, I would have just added another of those old sayings. I think it's time in the market beats timing the market.
Absolutely.
And that's also, I think, a good summary, really.
Okay, let's see what other questions have we got here. We've got a couple of people asking about the recording. Yes, this recording is going to be put up on YouTube on the InvestEngine channel. After this, it usually takes about a week or so, maybe a couple of weeks, to go through the various compliance departments and checks. But then if you keep checking into our YouTube channel, it will end up there. Okay, so question here. This is actually a really good question for both of you, given the topic of our last webinar. How do I decide between market cap weighted and equal weight ETFs? I don't know which one of you wants to take that one.
I can start off. I mean, I would say it's not an either or decision. The way that we see it mostly being used in the portfolio context is really having both lines in there. And then because you cover the same stocks, the same 500 names, it's just a matter of how you weigh them, dialing up and down the weights on each as the environment develops. That's an approach that we see quite often.
Yeah. Another good question for both of you. Somebody saying that there are multiple ETFs in the app with lots of different providers. So which do we choose? Good question. They cite a couple of examples. Is it just the one with the lowest cost? Is it on the highest yield? Is it the one with the best past performance? So what would you guys recommend investors look for when they're trying to decide between all the different ETFs, which on the surface can look quite similar?
Yeah, maybe I can jump in on that one. I guess the first thing is to understand the actual benchmark, the index that you're investing in, because even looking at European equity ETFs, there's a lot out there, right? whether it's Euro Stoxx 50, Stoxx 600, MSCI Europe, all of them are constructed slightly differently. So the country weights might vary, the sector weights might vary. So important that you do your homework and actually understand the exposure you're getting. And then if you're comparing like for like, so look, the same underlying benchmark, then yes, fees are important. But then also thinking about how good a job is the ETF provider doing in terms of replicating that index. So what are the key metrics to look at here? So the tracking difference. So the difference between the performance of the fund and the benchmark, and then also the tracking error as well. So the standard deviation of that tracking over time. So, and that can have a really big impact on your performance depending on your time horizon, particularly if you're like a short-term investor. If you invest in an ETF that has a high tracking error, then you can be penalized as a result. So fees, tracking, those, and then understanding the actual the benchmark that you're getting access to.
Yeah, I think that's a really helpful, I think, checklist for people to have a look at when they're going through and deciding all these very similar ETFs on the platform. Unfortunately, we have slightly run over by a couple of minutes, so I'm afraid I'm going to have to call it there. I can see that we have had quite a few questions coming through. So if we haven't answered your question today, then we'll try and get back to you over the next few days. You can always email support@investengine.com with your questions, and we will always get back to you that way as well. If you want to find out more about any of the Xtrackers ETFs, then just click the Xtrackers banner at the top of that investments page, and you'll find all the details about all their ETFs there. So all that is left for me to do is to say thank you to Lukas, thank you to Toby for your time today. I think it was a really good discussion. Thank you to everybody who's dialed in for joining, and I look forward to seeing you on our next webinar.
Thanks, Andy. Thanks all.
Thank you. Bye-bye.